What's up, YouTube? Welcome to the next video in this series, going strong, third one, and I'd like to try something a little bit different today. Talk a little bit more about current events, what's going on. If you noticed, this past week in the markets, stock markets specifically, have been insane, and we'll get to the bottom of that. And a large part of that has to do with the ongoing coronavirus outbreak all over the world. Now, what we're going to talk about today is a little bit of background on what's going on, how that specifically affects financial markets, what the government's doing to try and fix that, and more specifically, what you should do to continue investing, making some money. And I have a little bit of spoiler alert with that because there's some fun thoughts that people have when it comes to market downturns and recessions. I have my own personal beliefs. But before I get to that spoiler alert, just want to remind you guys to like and subscribe, be the first to see new content when it comes out, be the first to be notified, and just lets me know you enjoy what I'm putting out so I can continue to make it. So with that being said, here's the big spoiler alert. Don't panic, sell. I'm a long-term believer of buying and holding, and selling during a recession is not a great idea, and I'll sort of show you why towards the end of this video. But that being said, let's get right into it. So if you haven't been watching the news lately, there's a big virus outbreak that started in China, the coronavirus, the novel coronavirus, COVID-19. What's interesting about it is it's actually related to a few viruses that have caused outbreaks in the past, but not to as large a scale as the novel coronavirus has had. So COVID-19 started infecting people by late December in China, and by the beginning of February, 14,000 people were infected in China. Now that doesn't seem like a whole lot considering the population of China, but it had a big impact because a few years ago, if you remember back in the early 2000s, there was a similar virus, SARS virus, which actually was a big pain for the Chinese government. It was very infectious and it killed a large portion of people in Asia and actually moved over to Canada and started infecting people. And the government sort of had not a great response. So they started to shore up their response to coronavirus outbreak by quarantining cities, restricting travel into and out of some of the hubs where they started seeing large numbers of cases, and into and out of the country. And a lot of other neighboring countries in the United States and countries all over the world started restricting travel to China. Some businesses started restricting travel to other countries and travel to trade shows where infected individuals may appear. So despite these quarantine measures, which were gargantuan by the way, China decided to completely cut off millions of people in cities that tend to be hotbeds of these diseases. Now despite all that, by the middle of February 14th, 50,000 people were infected, and that's a pretty big deal. The good news is they found that coronavirus only kills about 2% of those infected, which is a relatively low number compared to specifically SARS and MERS, which are in the same virus family, but it is much more virulent. Around the same time, you start seeing cases crop up all over the world, and more recently you start seeing them crop up in places like South Korea and Italy, which are also large economies. Now, another one of the big quarantine measures they took was restricting travel into and out of Hong Kong. Now this was actually pretty much imposed by Hong Kong, who also within previous weeks has had a lot of protest activity restricting democratic freedoms in what's called a special administrative region of China. Hong Kong operates under an interesting one country, two systems rule. It was previously a British colony, and when handed back over to the Chinese in 1997, the British government stipulated some requirements that Hong Kong remain relatively democratic, relatively free from the financial requirements of the Chinese government. So it's not communist, it's a lot more of an open economic system. Now, the next question you may be asking is, well, how does this all affect the economy? Well, you have to put things in perspective. With the quarantine measures China put in place in ordering some workers to stay home and shutting factories, you have to keep in mind that China is the second largest economy in the entire world. To put things into perspective, in 2018, China was the world's largest supplier of steel by 53% of world steel production. They also have some of the largest coal reserves in the entire world. And probably the most significant here is they're the #1 exporter of silicon wafers, which are actually the base on which microchips are made. Year over year, China exports 4,600 thousands of tons of silicon wafers. That's the largest in the world. To put things in perspective, the second largest exporter only exports 747,000 tons. So there's a large disparity in the amount of raw goods that China puts out compared to a lot of other nations around the world. And that's just raw goods. China is also a large exporter of finished goods for the rest of the world as well. Now, what exactly does this mean? Well, it means a lot of downstream suppliers of more complex goods that rely on Chinese materials, mostly construction that'll use that steel all over the world, tech companies which will use those silicon wafers and microchips in their devices, and a big one is Apple, and we'll talk a little bit more about Apple in a second. They start to see those downstream effects. They don't have a steady supply of raw materials to produce their more complex goods like phones, computers, etc. So that really starts to hamper economic activities of larger conglomerates. And like I said earlier, Apple was actually one of the first to announce that they were going to face supply shortages due to the coronavirus outbreak in China. Now, another element to this is Hong Kong. Now, because Hong Kong was very highly populated before it was handed over to the Chinese and is a hub of investment banking, between these quarantine measures and the previous democratic protests, there was a lot of fear that there would be discouragement in economic activity in Hong Kong, basically utilizing all the financial banks that call Hong Kong home. Now, that's had a ripple effect across Asian markets even before coronavirus in late 2019, but it's still a significant impact to the banking sector. Now, it doesn't help at all that the coronavirus outbreak also tend to overlap with Q4 2019 financial earnings season. So that's when a lot of these companies will begin to come out and assess their impact and exposure to Chinese markets. And they can also assess their long-term outlook on how this virus outbreak will affect their downstream products, income, expenses, and eventually their profit. Now, there were a few other minor factors that went into what happened in the markets this week. There were some high-profile CEO exits, specifically at Disney and MasterCard. But those were relatively minor in terms of the major indices dropping. So I'll start to throw some numbers at you now. This past week, between February 24th and February 28th, just put things in perspective, I'm filming this on a Saturday, so we have the whole financial past week to look back on. The S&P 500 dropped over 9%. The Dow Jones Industrial Average dropped over 10%. In the NASDAQ, which is generally a good measure of financial companies and tech companies, dropped almost 7% over the previous week. Now, all of these are indices that give you sort of a broad market view. It handpicks a few companies across a whole bunch of stocks in stock markets and gives a general picture of financial health in stock markets. Now, those are huge numbers, and they actually approach what we call a correction, which is between a 10% and a 20% drop in stock market performance. Now, to be fair, we're a little late on a correction because corrections happen on sort of a cyclic basis. Ever since the financial crisis of 2008 ended, around June of 2009, the market had been on an upward trajectory, so we were actually sort of due for a correction, but it was just unexpected as to what would cause it. No one saw the coronavirus outbreak prior to 2019. That's another thing that is cyclic, is epidemics, new emerging diseases can cause market impacts, as explained earlier. Now, we certainly haven't seen an impact in the United States yet. There aren't any more than a few tens of cases in the United States. And as far as I know, I don't think there's been a reported death in the United States from the coronavirus yet. But the CDC also announced this week that it's not a matter of if, but a matter of when the epidemic will reach the United States. But even besides that, since the United States is the largest economy in the world, that economy has been drastically affected by these drops in the stock market due to the coronavirus outbreak. So a good question is, what is the government doing to try and help? Well, earlier this week, you probably saw the president on TV talking about emergency preparedness with respect to this epidemic. But largely what we're going to try and look at is the idea that the Federal Reserve interest rate, which we spoke about in our last video, there's rumors that that is going to be decreased. Now, there's a few impacts that will cause downstream. One, you've got lower interest rates on bonds like we talked about earlier, which will discourage safe yet steady investment returns. But the larger impact is that it makes all sorts of benchmark interest rates on loans decrease as well. So that encourages lending, especially for businesses that want to increase their growth in periods of downturns, and decrease downstream mortgage rates and encourage home buying. So largely, you probably will see a bump if and when the interest rates are lowered. But usually that's temporary, and it may try and slow the downturn, but this downturn may actually be a little bit longer term. Like I said, we are overdue for a correction, and we're actually overall overdue for a recession. On average, between recessions since the indices started tracking these market prices, they typically haven't gone on for more than 10 years, these upward trends before a subsequent recession. So we're actually due for one of those as well. So it's expected. That's bottom line. But I guess bottom line is, what does this mean for you, for someone, the average person who has money invested in the stock market? So you may be tempted when you see all these markets down to sell your assets and gain cash while you can before they decrease any more than they already have. That's actually typically very bad wisdom, especially if you're a buy and hold investor and you're looking at long-term making money. You really just want to ride it out. At worst, ride it out. My personal advice is buy the dip. This is actually a great time now that prices are down on average 10% across all these indices. It's a great time to buy at a value and let that value increase when there's an inevitable bump. To put things in perspective, after the recession of 2008 ended in June of 2009, that whole recession period had a decrease of about 35% across all markets. Now, 5 years after the end of that recession in June of 2009, the market's indices are up almost 137%. So if you had just kept your investments, you would have made back all the money you lost in the recession and then some, almost double. So like I said, give it a chance. If you have a little bit of cash lying around, now is a great time to buy into those indice dips, those asset dips, anything that's lost money over the previous week. And granted, it may continue to lose a little bit more money, but buy in, seize the day, invest. You'll earn your returns back after the downturn is over. Now, one asterisk I do want to put next to this recommendation to buy the downturn is, at the same time, don't try and time the market. If you see the market keep going down, don't try and think, okay, I'm going to look for the bottom and then I'm going to buy in. Statistically, that's not going to work. Typically, it never works. I probably made the mistake on Monday of buying a little in, and then it went down probably a good another 5-6%. But then at the end of the week, I bought even more because it was an even lower price. Right now, I'm predicting, like I said, I'm filming this on a Saturday. I'm predicting on Monday probably there will be a little bit of bump, and actually post-market activity on Friday afternoon tend to indicate that people were buying again, actually. So Monday you might see a little bit of a bump, but like I said, don't be scared if it ends up long-term. Statistically, you're much more likely to make money after the end of this downturn. So that wraps up this video. Hopefully it's a little bit shorter than the previous ones I've been putting out. I've been trying to aim for 10 minutes. That was a sort of a miss on the first one and a definite miss on the second one. But like I said, hope you enjoy the content. Like and subscribe again. And like every other time, I'm going to put a link in the comments or the description for this video to some great investment apps. Now's a great time to download them, start buying. Great value in what you can get today based on market activity this previous week. And I hope you check out new content in the future.